Hello, this is Casey Cooper here with Taylor Steele for the Cadent Capital second quarter 2024 economic commentary. And we're coming to you just a couple of weeks after the solar eclipse.
It was amazing to be in the path of totality. We were able to step outside and experience it. And it was interesting to think about interacting with the moon in a different manner. Usually we see the tidal effects instead of having it blocked out.
Yeah, and actually today we want to talk about some economic tidal effects that are in front of us, namely interest rate and inflation, as well as presidential election. We won't talk about that much today, but it's hard to ignore the surge of impact that it's having this calendar year, and also one that's starting to pull into effect, which is tax dynamics.
Yes, you may have already started seeing in the news a little bit, but the Tax Cut and Jobs Act of 2017 is set to sunset on January 1st, 2026. And the biggest impact for many of you will be the rolling back of the estate tax. Right now, it's $13.61 million per person, so a little over $27 million per couple. That is slated to roll back to $5 million plus inflation since 2017. So experts are thinking it'll probably be somewhere in the $7 to $7.5 million per person. So for those of you that have a net worth that is around 15 million or close to it, we're concerned that you're going to now have an estate tax that you're not subject to right now in our planning.
Also, there's some income tax dynamics related to this. Do you mind explaining what those would be?
Those would be the SALT, or the property tax piece, is going to be deductible more than $10,000. Right now there's a cap that hits at $10,000. It'll go back to unlimited, which will benefit many of you that have property tax of more than $10,000 a year. So as we get to the end of 2025, we'll remind you, but be considering waiting and paying that until the first month of 2026 when you can get it fully deductible, or at least paying $10,000 at the end and then the rest in 2026.
And that would be more applicable for those that are itemizing or did so prior to 2017 if their fact pattern hasn't changed dramatically. And are there any other itemized deductions?
Yes. The 2% miscellaneous category comes back. And what that means is professional service firms like Cadent and attorneys, they will have their fees being able to be deducted again to the extent that it's above 2% of AGI. So if that comes back into effect like we expect it to, we'll be able to provide you with that, and hopefully you and your CPA can find the ability to deduct that on your taxes again.
Yeah, and while we know this is set to roll back, given we are in an election year, it's difficult to project what the dynamics will be until we start to see the outcomes of the fall elections.
Yes, and many of you will ask us, it doesn't matter which party wins. We find, like Casey said, with the tides, that there's nervous anticipation heading into the elections, but generally the market is agnostic on who wins, and they just like to know what the rules will be for the next couple of years from a business environment and adapt accordingly. In addition to the presidential outcome question, the one that we're getting the most often right now is, when will the first Federal Reserve rate cut be? As we've seen after the March meeting, traders priced in 7 cuts coming before the end of 2024. It seemed like a lot, and Chairman Powell came out after the April meeting with some new comments that reframed that.
Essentially, Chairman Powell shot across the bow of those traders and said, hang on, we're not having any kind of activity like that. Not only did he suggest that 7 rate cuts was insane, which was certainly a tone that I would take from it, he explicitly stated there may not be a rate cut at all in calendar year 2024. Now, that is not welcome news for most investors or consumers. Relief from higher interest rates would be welcomed by virtually everyone. However, there's a very positive tone inside of that if we peel back the layers just a little bit. The reasons why there may not be a rate cut is because we've already had market rates lower down. And if we rewind a few months, after a series of rate hikes, the bond market, and this was across the term structure of treasuries, from 6-month treasuries all the way to 30-year, bond rates had lifted. But then through a rate hike cycle for the Fed, they had proven to be peskily resilient and sticky at an intermediate level below where the Fed was trying to move rates to.
They were essentially flat.
They were essentially flat for an extended period, in a period where the Fed increased rates 1.75%, market rates weren't moving. Then the Fed in the summer of 2023 goes into a pause cycle on rate increases, signaling that still more rate hikes were to come before year end. After 2 or 3 meetings, the bond market started to, in our viewpoint, view the chairman as a reliable narrator, and bond rates in the market started to lift significantly. Chairman Powell late last year said, we no longer need to raise rates at this time. We'll be paused longer, and we no longer need to raise rates because market rates have done the job for us. Well, what we've seen now with the April comments is the economy is proving resilient still. GDP, the value of all goods and services produced in the US, is ticking higher. So a healthier, more robust economy than expected. Unemployment has ticked down from 4% to 3.8%, again, showing some broad resilience despite pockets of weakness in the economy. And with that, the bond market has decreased. Market rates have decreased. Like when Chairman Powell said the bond market has done our job, we no longer need to raise rates. They're essentially saying the same thing now. Bond markets have decreased. We no longer have room. Otherwise, we risk picking inflation back up before it's been tamped down on their path to 2%.
Right. And on the path to 2%, part of the outcome of the April meeting was a glide path that core inflation won't be down to the 2% target till sometime in 2026 is what they're seeing right now.
Right. And core inflation at 3.8% today, and it's been a steady decline as we shared in prior videos and discussions with you, but at a very steady, slow drip lower, if that path continues, we're likely to see some mixed economic data along the way. We certainly always have the possibility of some geopolitical or economic shoe dropping. And while the economy is proving more resilient right now than expected, we don't believe that the broad resilience is strong enough to pull us out of any and all problems that might arise. So the sentiment or the tide of sentiment, we could see shifting back and forth considerably this year, especially given we're in a presidential election cycle, which tends to add heightened volatility. So from a practical perspective, at this moment, we're trying to be opportunistic on both ends of the spectrum. For those that have near-term spending, we're wanting to just keep tuning up and plucking off those pieces of the portfolio that have either done well or done surprisingly well recently to bolster cash. Or for those that have deployable cash, we're looking for moments of weakness to do the same thing on the opposite end of the spectrum. The nice thing about choppiness, volatility, and just lack of clarity is it presents opportunity.
Right. So if there's an opportunity that you see in your own personal finances that you think we need to be aware of, please feel free to reach out and let us know.
Thank you.